the RBI is in some sort of a catch-22 situation, because while on the one hand you would like to see the centre move on the subsidy front and address the issue of administered prices, on the other hand you are trying to address inflation. So getting administered prices to get corrected to market is inflationary in nature, while at the same time you are fighting inflation on the other hand.
No, yes, you could describe it as a catch-22 situation, but as I just said, whether you adjust fiscal deficit or do not adjust, you have inflationary pressures. That indeed is a catch-22 situation. But unlike a classical catch-22 situation, the options are quite clear here. I think even both the short-term and the medium-term options, medium-term interest will be better served if we make the adjustment on oil prices.
Right, now we keep talking about large government borrowers having the potential of crowding out private investment. But isn't that already happening? Because you see private sector companies being forced to borrow at significantly higher rates in the market while competing with their public sector counterparts. And just to take one particular example, the HUDCO tax-free bond was one example where it forced AAA corporates even to pay much more. So isn't that already happening rather than it potentially happening?
Well, to some extent, yes. Crowding out has happened, but crowding out could become more intense when the economy starts reviving. Last year, private credit demand was quite muted, and therefore crowding out did not happen as much as it otherwise would have. But if we want economy to revive, investment to revive, we need private credit demand to pick up. And private credit demand will pick up only if interest rates are competitive. And for interest rates to be competitive, government borrowing has to be coming down.
Right. Also now focusing on the current account deficit, you said that continues to pose a major challenge. And you've also said that the 4.3% trend is unsustainable and needs to be contained. But in an environment where the CAD is widening so much, was a policy rate cut the right thing to do?
I would believe yes. Again, I have to go back to our impossible trinity concept. What we do on monetary policy side has implications for the external sector. What we do on the external sector has implications for monetary policy, even if we try to treat them in separate compartments. Okay. There is, of course, a high current account deficit, which is partly a reflection of the demand in the economy. Okay. But if you drill it down, the exports have moderated because of the external situation over which we do not have much control. On the other hand, imports have increased because of oil imports, oil prices being firm, and because of gold imports. And gold imports have increased because of its safe haven effect, its hedge against inflation. So I believe that if we run a low inflation scenario, the appetite for gold will come down and current account deficit the pressure should be softer. Again, if we make the adjustment on oil prices, that again should have a softening influence on current account deficit. So I do not think that yesterday's policy action should be viewed as exacerbating current account pressures. On the contrary, it must be viewed as a way of softening the pressures on the current account deficit in the medium term.
And staying with the subject of the current account deficit and the related aspect of the currency markets, there is a view in the markets that based on the the restrictions that you imposed on the currency markets in November, December of last year, the current levels that you see on the rupee are somewhere artificial in nature, that they aren't at their right levels. Is that something you'd agree with, to the extent that volumes have dropped significantly?
Well, we believe in the Reserve Bank that the exchange rate must be market determined, and we must intervene only to smooth volatility and to prevent disruptions to macroeconomic stability. So to the extent that we've imposed certain measures and that's thinned the market, still the exchange rate is market determined, of course in a thinner market. Okay. If the implied question is, are we going to relax those measures that we had instituted in mid-December? Some we have already relaxed. and some we might do if the situation so demands. But it's not as if it's not as if we will undo all of them in a fixed period of time.
Right now, again, focusing on the credit deposit scenario, you've projected credit growing at something like 17% and deposits at 16%. At the same time, there's a big worry among bankers about deposits in the banking system getting crowded out by other smarter investment products that are tax-free in nature and of longer tenors. To that extent, bankers worry about deposit growth, and again, to the extent that credit growth is going to far outpace deposit growth going forward. Do you at the RBI worry about a larger structural liquidity deficit emerging within the banking system?
Well, to the liquidity pressure itself, we've given sufficient guidance in the policy yesterday that liquidity pressures have eased. Last year we saw somewhat of an uncommon situation because we had to intervene in the foreign exchange market. But we had more than offset that by our open market operations and by reduction in the CRR. But it had tightened because of government cash balances building up. This liquidity pressures have since eased, and we have given guidance that we will manage it quite actively and to the extent possible see that it is within the range of plus minus 1% of NDTL. But on the larger question of the competitiveness of bank deposits, you're right that if there are alternatives that are more attractive, it will be that much more difficult and structurally more difficult for banks to mobilize deposits. And we have to have a financial system where the returns in the entire financial system respond to RBI's policy signals through monetary transmission. But here we have a system where banks are required or obliged to respond, and there is another saving system of small savings and these tax-free bonds which are not so sensitive. And I think we must address these rigidities.
So how do we address those rigidities?
Well, we need to address those rigidities by government adjusting, becoming more interest rate sensitive in calibrating these interest rates on small savings or allowing the tax breaks on bonds.
Again, Governor, in your introductory remarks in yesterday's policy report, you've talked about deteriorating asset quality. Would you say that the asset quality within the banking system is becoming a point of concern for the Reserve Bank of India, increasingly becoming a point of concern?
Well, yes, it is becoming a concern. But again, I don't want to sound alarmist. It's within safe limits. Okay. But however, because of the downturn in the economy, because of the restructuring done, the deterioration in asset quality has been more than we see at normal times. Okay? And we've been mindful of that for the last 9-10 months. In fact, that was the high point of our January policy review. Since then, our deputy governors had a meeting with the top 10 banks to understand the intricacies of this problem. And banks have told us yesterday that they're seeing a turnaround. We've also instituted a measure in yesterday's policy to improve banks' risk management systems in order to detect potentially bad loans ahead of time.
Now, also, Governor, you've come down fairly heavily on gold loan NBFCs. First, you reduced their loan-to-value ratios to 60%. Now you've restricted bank lending to gold loan NBFCs. Is your bigger concern that of concentration risk within the financial system, or is the larger worry that of unproductive assets being imported into the country, which is essentially inflating the import bill?
Well, both, I would say. But the more immediate worry is the stability concern, sudden growth in loans against gold, the concentration risk involved there, and not only to the NBFCs which are involved in this, but to banks who are lending to the NBFCs. Therefore, we we added to the measures that we instituted 2 weeks ago. 2 weeks ago, we had tightened regulation of NBFCs. In yesterday's policy, we tightened regulation of banks lending to NBFCs, lending against gold. That's one aspect of it. But the other dimension that you mentioned, which is that it's adding to gold imports. Okay, as much as that is a larger issue, if loan facilities against gold are made more restrictive and more prudent, I believe appetite for gold might come down.
Sure, but also, Governor, banks, seeing the success that gold loan NBFCs have also started pursuing that line of business fairly aggressively, and there have been numerous banks who started building up reasonably substantial gold loan portfolios. So is there any move at the RBI to also sort of govern that exposure of banks to gold loans?
Well, I cannot tell you if there is any move, but as of now we've found that there is no need for concern in that regard, because as Deputy Governor Anand Sinha said in the press conference yesterday, banks are different type of actor. NBFCs are doing only that business, whereas banks have a diversified portfolio. They are more tightly regulated. So should there be any concerns, we will respond at the appropriate time. But at this point of time, there are no concerns about banks lending against gold.
But also, there's been a lot of expectation from the foreign bank community as to when the subsidiarization guidelines, the final guidelines, will be out. What should we expect there, and when should we expect it?
Well, I must admit that it's taken longer than we had anticipated. But it is currently stuck or delayed because the government has to give very clear indication on what the tax implications will be when a foreign bank subsidizes. So we are in active dialogue with the government, and I cannot really indicate a time frame, but I'm hoping that we will bring this issue to a logical closure sooner rather than later.
Also, Governor, on the new private bank guidelines, you did put something out in August of last year. How soon before we see any progress on that front?
Well, you all know that the missing link in that is the amendment to the Banking Regulation Act. And we've said that amendment to the BR Act is a precondition for moving forward in this regard. And that is within the realm of the legislature. I have been given to understand that the Finance Minister is planning to get that done in this budget session of the Parliament. So all I can say is that.
All right, Governor, thanks very much for taking
Many thanks, George. I enjoyed this opportunity of being on ET Now.
Thank you.